Okay, let's be honest, corporate filings can look pretty dense, right? But buried in all that jargon is the real story of a company's health and its future. So today, we're going to dive into a key filing from Root Mobile and figure out exactly where it's headed. Let's get into it.
So this is it. This is the actual document we're going to be picking apart, the one they sent to the stock exchanges. And this is more than just paperwork. Think of it as a direct line from the boardroom to investors. And this one, from their meeting on February 9th, is packed with some really important updates.
So what's the big story here? Well, you've got a new CEO stepping in, you've got dividends being paid out to shareholders, and then you have these multi-core disputes that the auditors are flagging. It sounds like a lot, I know, but we're going to connect all the dots and see what this really means for Route Mobile's future. First up, let's talk about the people. Because, changes at the very top, they often tell you the most about where a company is heading. So who's in the driver's seat now over at Root Mobile? Here's the big news. It's a leadership shuffle. Mr. Rajdeep Kumar Gupta is shifting from the CEO role to become the managing director, and taking his place as the new CEO is Mr. Tushar Agnihotri, who was previously running things for India and the Asia-Pacific region. Now, this isn't just swapping nameplates on the door, right? This is a big deal. When you promote the person who's been leading your charge in India and APAC to the top job, well, that's a pretty strong signal that you're doubling down on growth in those key markets. And it's not like we have to guess what his job is. The filing spells it out loud and clear. The new CEO's mission is to accelerate the growth and profitability. That's business speak for pedal to the metal. They want faster results, period. It really sets the tone for the company's next chapter.
Okay, so we've talked about the leadership. Now let's move on to something that hits a little closer to home for investors, the payout, the dividend. This is how the company shares its success directly with its owners. And the magic number is 3 rupees per share. Now, it's important to note this is the third interim dividend this year. An interim dividend is basically a payout the company makes before all the final year-end numbers are crunched. It's usually a pretty good sign that the board feels confident about how things are going right now.
So how does this actually play out for a shareholder? It's really a simple 3-step dance. The board gave it the green light on February 9th. To get paid, you had to be on the official shareholder list by February 13th. And finally, that cash will hit accounts within 30 days of that first announcement. See? Nice and straightforward. All right, we've covered the people, we've covered the payout. Now let's pop the hood and look at the engine room, the financials. How did the company actually perform this past quarter? Okay, so take a look at this. We're comparing this past quarter with the same one from the year before. And what you see is pretty interesting. Total income, it's actually down a little bit. But, and this is the key part, look at the expenses. They've managed to cut those down quite a bit. So what's the result? The profit is actually up. It jumped from about 85 crores to over 102 crores. That's a story of efficiency, right? They're making more money on every rupee that comes in. In fact, their profit margin has climbed from around 7.2% to over 9.1%. That is a healthy improvement.
Okay, now for the part of the report that always requires you to put on your detective hat, the auditor's notes. This is where the independent number crunchers point out things they think investors really need to know, even if it doesn't totally change the bottom line. You got to read the fine print, right?
But before we dive into the nitty-gritty, the auditors say this, and it's super important. Our conclusion is not modified. So what does that mean? It's kind of like your mechanic saying, hey, the car is totally safe to drive, but I gotta tell you, there's a weird noise in the engine and one of your tires has a slow leak. It's not a red flag to stop the car, but it's definitely something you need to keep an eye on. So what are these things to watch? Well, there are 2 big ones. First, there's a major legal battle with a vendor. They're in advanced settlement talks, which is good. But this comes after the company already had to write off a massive 108 crores for the same issue. Ouch. Second, a different vendor just went out of business, and Route Mobile had paid them in advance of almost 28 crores, which now looks like it's probably gone for good. So yeah, these are not small issues. They represent real financial risk. Okay, so we've got a new boss, a dividend for shareholders, better profits, but also these lingering legal headaches. Let's tie this all together. What's the bottom line here? So here's what you really need to remember from all this. Number 1, new leadership is in place with a clear mission: accelerate growth. Number 2, the company is rewarding shareholders with that 3 rupee dividend, which shows confidence. Number 3, profits are up. They're running a leaner, more efficient ship. And number 4, you can't ignore those vendor issues. The auditors have put them on the watch list for a reason. That's the whole story in a nutshell.
And all of this leaves us with the big question, right? You've got this fresh energy from a new CEO, you've got healthy profits, but you've also got these legal shadows hanging around. So, what does the next chapter for Root Mobile actually look like? This filing really paints a picture of a company at a crossroads. It's profitable, for sure, but it's also facing some serious challenges. How they navigate this next phase is going to be fascinating to watch.
Welcome back to the deep dive. So, we're trying something a little different today.
Yeah.
Usually we're buried in, PDFs and quarterly reports.
Right, mountains of text.
Exactly. But today we are focusing on just one thing, a single artifact. It's a screenshot of a weekly candlestick chart for Root Mobile from the NSE.
It's a good change of pace. I mean, a single chart can tell such a story about market psychology, sometimes more than an entire analyst report.
It really can. And just to set the scene for everyone, we're looking at a huge timeline here. This thing stretches all the way from early 2020 right up to, well, right now, early February 2026.
It's a 5-year saga, a perfect textbook example of a market cycle, really.
It is. You can see the whole story.
Yeah.
So before we get into the history, let's look at the now, the live data for this week.
Okay.
It closed at 619.25. It hit a low of 573.30, but managed to pull back.
And that number, that 619, you have to put it in context.
Oh, yeah.
If you look at the peak on this chart, back in 2021, it was trading well over 2,000.
Way over.
So we're talking about a 70% drop from its all-time high. That's just a massive destruction of value.
That's the first thing that hits you, that 30,000-foot view. It looks like a giant, rugged mountain.
Mm-hmm.
You've got the sheer cliff going up on the left, this sort of jagged, messy plateau at the top.
And then the long, painful slide down the other side.
Exactly. It's less like a stock chart and more like a map of a hike that went horribly wrong.
And that jagged plateau at the top, the part
Yeah.
that spans from, 2022 to early 2024?
Yeah, that long sideways section.
That's what technical analysts call a distribution structure. It's fascinating because for 2 years, the stock just churned. It went nowhere, really.
Between about 1,200 and 1,600.
Right. And to an untrained eye, that looks like stability, but really, that's often where the so-called smart money is quietly getting out.
While everyone else is holding on, thinking it's building a base for the next move up.
Exactly. And you can almost see a faint head and shoulders pattern in there. You see a peak, a higher peak, and then a lower peak. That lower one in early 2024, that was the kiss of death.
It showed the buyers were just gassed. They couldn't push it back to the old high.
They were exhausted, and once that support around the 1,200 level broke, the floor just fell out.
Which brings us to the waterfall.
Wow.
Mid-2024 onwards.
Yeah.
I mean, look at the candles. It's just red after red after red.
It's visceral, isn't it?
Oh,
It's just relentless selling pressure.
So let's talk about the technicals here. I'm looking at that smooth red line that's kind of snaking its way through the price. And that's a moving average, right? A longer-term one.
Yeah, on a weekly chart, that's probably a 20-week, so roughly a 5-month average. It's the consensus of value.
And what's so striking is the angle. Back in 2020, 2021, it was pointing straight up, and the price was just surfing on top of it.
A classic uptrend.
But now, it's a ceiling, a very distinct ceiling.
That's the concept of dynamic resistance. You see those little rallies in mid-2025 where the price tries to bounce.
Yeah.
Every single time, bam, it hits that red line and gets smacked right back down.
That's like an electric fence.
It is. And it tells you the trend is still in control. Until the price can get above that line and the line itself starts to flatten out, any rally is guilty until proven innocent.
So that red line is basically the no-go zone for a cautious investor.
It's your caution flag. You're fighting the primary trend if you buy below it.
Okay, what about the volatility? I'm looking at those two wavy green lines, the Bollinger Bands, that kind of form a tunnel around the price.
Right. They measure standard deviation, basically how volatile the market is.
And in 2023, they got really tight. They squeezed together.
That was the calm before the storm. Low volatility always leads to high volatility. When those bands expanded in late 2024, that was the signal that a huge move was coming.
And it was a move down, unfortunately.
A big one. And look at how the price has been behaving since then. See how the red candles are glued to that lower green band?
Yeah, they're just grinding against it.
That's a phenomenon called walking the bands. It's a sign of extreme weakness. It means the selling is so powerful it's constantly pushing the statistical boundaries of where the price should be. It's capitulation.
Hang on. If you look at the very end of the chart, like right now, the candles seem to be pulling away from that lower band just a little bit.
Good eye. That's the first hint that the downward momentum might be slowing down. We're not crashing quite as fast as we were a few months ago. The bands are still wide, so risk is high, but we're not piercing that lower level anymore.
Okay, that brings me to the panel at the bottom. The RSI, the Relative Strength Index.
The momentum oscillator.
Yeah, and that purple line is way down low, deep in what people call oversold territory.
It is. It's well below the 30 level. But you have to be careful with the word oversold.
It doesn't mean buy now.
Not at all. A stock can stay oversold for a very long time in a crash.
But here's what I'm seeing, and tell me if I'm crazy. The price itself, it made a new low in late 2025, and then another even lower low just now at 573. But the RSI line, the purple line, it didn't.
Huh.
It's actually flat. It made a higher low.
You're not crazy at all. That is a fantastic observation. That is classic bullish divergence. It's one of the most powerful reversal signals a trader can look for.
So what does that actually mean in simple terms?
Think of it like a car rolling downhill. The price is the car. It's still moving down, making new lows. But the RSI is the speed of the car. It's decelerating.
Okay.
The sellers are running out of gas. The selling pressure is exhausting itself. It doesn't mean the car has stopped, but it's a sign that it might be about to.
So we have this conflict. The trend, the red line, looks awful, but the underlying momentum is saying the worst might be over.
Exactly. And that tension, that's where bottoms are formed.
So let's zoom right in on that. The now.
Yeah.
That very last candle for this week.
Okay.
It opened to 580. It dropped all the way to 573.30. But then it rallied to close at 619.25. It leaves that long tail at the bottom.
In candlestick terms, we call that a hammer or a pin bar. It's a reversal signal.
Tells a little story, doesn't it?
It does. It says the bears tried. They pushed the price down to 573, but they couldn't hold it there. Buyers stepped in and said, nope, and pushed it all the way back up.
That's a rejection of lower prices.
A very strong one. And if you look at the tiny volume bars at the very bottom of the main chart, you see a little uptick in the last few weeks.
Yeah, they're getting a little taller.
That's your confirmation. That's likely institutional accumulation. The weak hands are panic selling at the bottom, and the strong hands are stepping in to buy it from them.
So we have the hammer candle, we have the RSI divergence, we have rising volume. Sounds like a pretty good case for a bottom.
It's a good case.
But we're still under that big, scary red line.
And that's the problem.
Yeah.
That is the entire problem. If you buy here at 619, you are still fighting the primary trend. You are betting on the turn before the turn has actually happened.
You're trying to catch the falling knife.
Precisely. And sometimes you catch the handle and sometimes you don't. The risk is that this is just a dead cat bounce. It could rally to, say, 650 or 700, hit that red line again, and then roll over and make new lows.
So for a more conservative person, what does confirmation look like? What are they waiting to see?
You're waiting for a weekly close above that red moving average, and not just a poke above it. You want to see the line itself start to flatten out and curl upwards.
By the time that happens, the stock could be at 750 or 800. You've missed the first 20% of the move.
That's the trade-off. It's the cost of insurance. You can either pay with risk by buying near the potential bottom, or you can pay with price by waiting for confirmation. There's no free lunch.
It's fascinating. We've spent all this time on Root Mobile, and we haven't once mentioned what they actually do. Something about cloud communication, APIs.
And we don't need to. That's the point of this kind of analysis. The chart aggregates all of that information. The insider who knew earnings were going to be bad, they sold months ago. That's the Head & Shoulders top.
And the fund manager who thinks the company is a deep value play.
They're the ones creating that volume spike at 600 right now. All the fear, greed, hope, it's all painted right there in the price and volume.
So to synthesize this, we have a stock that's been hammered. The long-term trend says stay away.
But the short-term evidence, the RSI and the last candle, are saying, hey, a bounce might be coming.
The patient is in the ICU. The pleading has stopped for now, but they are absolutely not out of the woods.
So it's a perfect analogy. The disease is the downtrend, and it hasn't been cured yet.
So here's the thought I want to leave everyone with. Look at how long this took. The rise took about 2 years. The fall has taken nearly 2 years. These weekly chart cycles are incredibly long.
We are.
So even if 573 was the absolute bottom, how much patience do you as an investor really have? The recovery, if it comes, might take just as long. Are you patient enough to wait for that red line to finally turn?
And to sit through all the supply from the people who are just waiting to sell and get their money back at 1,200?
A tough question. Well, this has been a fantastic look at one single chart. Always watch the red line.
Always watch the red line.
Thanks for joining us on this deep dive. We'll see you next time.